Hello, AFP members. I hope you're enjoying this year's Not Congress and taking advantage of all of the great sessions that are being held. We know that AFP is doing some terrific work to support the fundraising community, so CIBC is delighted to have the opportunity to act as a platinum sponsor for this year's conference. My name is Steve Kuahara. I'm the team leader for CIBC's public sector and not-for-profit group. We're an industry specialty team, and we focus specifically on providing banking services to charities, not-for-profit organizations, and public sector entities. We provide a broad range of banking services to our clients, including financing, cash management, and investment solutions. And our clients include many AFP members, and we'd be happy to provide assistance to you regarding any of your organization's banking requirements. As a service to our clients, we hold various workshops and seminars on topics of interest to not-for-profit organizations. And in that regard, we thought we would provide you with this presentation as part of AFP's 2020 annual conference. So my colleague, Jamie Golombek, is going to discuss fundraising strategies during and after the COVID-19 crisis, including strategies that charities can use to target specific donor groups. So by way of introduction, Jamie is a managing director of CIBC's tax and estate planning team. He's frequently quoted in the media and writes a weekly column in the National Post. And Jamie is also very active personally in the not-for-profit sector and sits on the boards of a number of Toronto-based charities and foundations. Jamie, on that note, I'll turn things over to you.
Well, thanks very much, Steve. What I'll do in the next 30 minutes or so is sort of walk you through a presentation we've been updating sort of every year for the last number of years on philanthropy. We call it One Size Doesn't Fit All. Tailored philanthropy solutions. And what we're planning to do is really go through a number of areas. Our agenda will start with an overview of charitable giving in Canada, look at some numbers for you, and then we'll look at very specific target areas like new graduates starting a career, employees, business owners, high net worth individuals, seniors, and then go over some estate planning traps as well. And I'll try to weave in some of my stories personally in terms of charitable giving, as well as working with clients, as well as some of the charities that I'm involved with, including sitting on the board of here in Toronto. So let's start with the overview of charitable donations. So I think the place to begin is the big picture. If you look at the trends in estate distribution, it's estimated there's going to be $10 trillion of wealth transfer over the next 20 years in North America, and a significant share will be directed for philanthropy, and that's estimated to be around $50 billion with a B dollars. It's a tremendous opportunity for families to discuss charitable giving as well as their philanthropic goals. Now, people sort of say, what is the main motivation to give? And then the way I explain this when I meet with clients, because we meet with high net worth clients almost every day, maybe every other day, one of the things we always talk about is philanthropy. And I say to them, look, after you've carefully planned for yourself and your family, think of charitable giving as one of your children and ask yourself, what are my philanthropic interests? Have I shared those interests with my family? And do I really hope that the children will continue to give beyond my lifetime as well? And these are values that we instill in terms of multiple generations. So it used to be that I thought that the main motivation that people gave was to get a tax receipt. In other words, a lot of people thought that really that is the main motivator for philanthropy. In fact, it's actually not true. It's actually at the bottom of the list. So if you take a look at a survey that was done on why Canadians actually give, number one, 79% of people give because they want to support a cause that they feel passionately about or that benefited their loved ones directly. We think of things in that regard in terms of like maybe giving to a hospital or to a university. The second reason at 69% is to share their good fortune. They've done very well. They've sold a company in some cases. They've done very well from an employment perspective. And they want to share that perhaps in the local community. Number three, at 63%, to support specific projects in their own community, maybe in the field of arts or in the field of medical or education. And then as we get further down the list, 29% do it to fill in some gaps in government support. They see government is not supporting a certain area. They want to fund that specifically. And then finally, only 11% are giving because of the tax benefit. So right at the bottom of the list. So the message here is, once we've identified that there is a philanthropic intent, why not be tax efficient? And that is really the whole point of what I want to talk to you about today. How can we be tax efficient in terms of our charitable giving and our discussions with our donors? What we've done is put together some data that really looks at how much people make and who's giving and how much people are giving. So you can see that based on the most recent data that we have, the 2017 tax year, that in fact 28.5 million Canadians filed a personal tax return. Of those, 66% of those returns reported income under 50,000, 25% reported income between 50 and 100,000, 6% reported income from 100 to 150, and you can see all the way to that top 2% is 150 to 250, and then the top 1% of returns, that's where you have the income of over $250,000 a year. So that's just in terms of where the income lies. The next thing that we looked at is donors. So in Canada, for the 2017 tax year, as filed by the Income Statistics by the CRA, there were 5.5 million donors. Now, that includes individual donors who donated cash or some kind of securities that reported on a tax return. This does not include, non-monetary donations like volunteering and time and things like that. So 5.5 million people gave some type of financial donation that they reported on their tax return. And we could see the breakdown. 36% of those people were making under 50,000, 41% 50 to 100, etc. Now here it gets very interesting. Let's now look at the breakdown of income. So you take all the tax returns that were filed for the 2017 year, and you add up all the income that was reported on all 28.5 million returns, and you get a staggering $1.4 trillion of total income earned in Canada and reported on a return. Okay, that's pre-tax income. And you can see that about a third of that income is reported on people with income under 50,000. 35% is all the people making 50 to 100. And you can see, of course, that the income skews far to the right. In other words, in the top 1% of people are basically earning 12% of all the income. But the most interesting stat I've saved for last, and that is the percentage of dollars of donations. So even though most Canadians, 2/3 of Canadians, earn under $50,000 a year, you can see that the amount of charitable giving accounts for only 16% of the dollars donated for the 2017 year. And the most interesting thing to me is the top 1%. The top 1% of Canadians who are making over $250,000 a year donated 33% of the $10.5 billion of donations given in Canada for the 2017 year. And the point of all this is to show you that we're all going after, in many cases, if we're looking for these big dollars, the same people. It's the top 1% that are giving 1/3 of every charitable dollar donated in Canada as reported on the returns. So what we're going to do today is we're going to take a look, obviously, how to get those big gifts, but we're going to talk about small gifts too. We're going to talk about all different levels and way to target different types of donors depending on their means and depending on their ability. Let's begin with a review of the donation tax credit system. I'm going to use Ontario as an example, and then I'm going to show you a comparison chart with all provinces, because know that there are people from all provinces in Canada that are watching this today. So first of all, as we know, there is a two-tiered donation system for donations under $200 in a year and for donations over $200 in a year. That's cumulatively across all donations. So let's say in Ontario, for donations up to $200, it's a 15% federal credit, a 5% Ontario credit, you're getting 20% back. Once you start to get the donations over $200, it gets a little bit more complicated in Ontario, and that's because of our two-tiered surtax, as well as the high income tax rate on the federal side. So effectively, what you get in Ontario is a tax credit that jumps right away to 40%, and ultimately could go as high as 50% for a high income earner subject to the top rate federally, the 33% federal bracket. So this is a bit of an anomaly in Ontario because of the two-tiered surtax credit, and you actually get a very interesting result. If we can throw up on a chart, for example, the federal and Ontario tax rate, and that's that line that you're going to see in red here, and you can see that caps out at 53.5%. The blue line is the donation credit rates that I just showed you. And you get a very interesting result because once you donate over $200, you're going to see that your donation tax credit rate is actually higher than your tax rate on income up to about $150,000. That's because the blue line is higher than the red line. When you get over that, there's actually a bit of a mismatch because Ontario never matched the top rate on the higher amounts of tax payable on income. So effectively, in almost every province, not quite in Ontario, the tax rate for donations is the highest tax rate once you're over $200. If we do compare it on a province by province basis, this slide here shows you all the different provinces and the territories on what the top marginal rate is on regular income on the left column, the credit on the first $200, and then the credit on anything above that, depending on whether or not you got income subject to that high federal rate above $214,000. And you can see that in most provinces, the very right column is equal to or higher than the very left column, meaning that in nearly every province in Canada, you basically are getting a full credit for any amount of tax payable on income that you donate to charity. So that is the starting point. Let's just mention another quick rule. There is a carry forward period. So any donations that you can't use in the current year because of the income limitation of 75% can be carried forward up to 5 future years. And there's a special limit for donations of ecologically sensitive land and Canadian cultural property. That's beyond the scope of today, but there are higher limits for that. Let's spend a few minutes and take a look at different types of donors and how I might approach them, beginning with new graduates. So let's say someone's starting their first job, they got a great job, and they're going to make $50,000 in that first year. They want to donate $500 to charity. That's how much they're going to give. So if we break it down using Ontario rates, on that first $200, it's 20%. On the next $300, it's 40%. So when you add up the total break, you get $160 of credit for a net cost of that donation of only $340. And that's how I sort of, I discuss it with people that are just starting out in their career. Can you afford to give? Can you make a $500 gift? Well, $10 a week, that's 50 weeks for a year, that's about $500. The real cost you is only $340, right? So when you look at it, is that the cost of, maybe a latte or two a week, you can make a $500 donation to charity. So that's the way I sort of pitch sort of lower income individuals who are going to make a cumulative donation of only $500. Then we'll talk about the broader base of employees. So if you're working with employees and they're part of, let's say, a big company like a bank, like CIBC, or a big insurance company or a publicly traded company, chances are they're participating in the share purchase program. What an opportunity to discuss the donation of appreciated securities with them, or in fact, for any donor. And the example I'm sure you're very familiar with, if I've got $1,000 of publicly traded securities with a cost base of $600, my capital gain is $400 if I were to sell those securities. So if I sell those securities and donate the cash to charity, I have to pay tax on my capital gain. And as you can see by the left side of this chart, the total cost of making that gift is $600 because I'm getting my receipt for $1,000, but I'm going to have to pay my tax of $107. If instead I donated that security in kind to charity, if we take a look at the right side of that chart, you can see that the capital gains tax is zero. Because of the special incentive to give appreciated securities to charity, I still get my receipt for $1,000. That's worth about 50% in my example. So I've reduced my net cost to $496 for a $1,000 gift. In other words, I've eliminated the capital gains tax and I've been able to give the money to charity. So a great opportunity. It's amazing how few people know about this. Again, I'm on the board of one of the foundations of a major charity in Toronto, and I asked them to run a report for me last year. Can you list me all the donors who gave at least $10,000, which I thought was a major gift, $10,000 to that charity? How many of those donors gave a gift in kind? And I think, if I remember correctly, the number was only 7%. In other words, people are writing checks. And it doesn't make any sense at all, because if you've got $10,000 to give to charity, you'll probably have a stock portfolio. And if you looked at the stock market for the last 10, 15 years, for the most part, it's been up. So you should question it. And in fact, I've told the boards of some of the charities I'm involved with, if you ever get a check for $10,000 or more, don't accept it. Don't cash it. I sort of say that tongue in cheek, because what I would say is I would pick up the phone and call the donor and say, thanks very much for the gift. Before I cash your check, why are you not donating securities in kind to save the capital gains tax? And we were dealing with a scenario just last week. We had a family, they had money in a trust. They were worried about the 21-year deemed disposition of the trust. There was going to be a massive capital gain. When we analyzed the trust, we noticed that that capital gain was mostly two stocks, Apple and Microsoft, with a 90% gain, massive tax bill. So we said, what an opportunity to roll those stocks out of the trust and then make a donation to charity and get the receipt in your personal name. So lots of opportunities for charitable giving. The best story I'll tell very quickly is, years ago I was asked to engage with a CEO of a major Canadian company, and we talked about tax planning, trust planning, estate planning, all kinds of stuff. And I said, what about charitable giving? He goes, Jamie, I'm a huge donor. I donate to United Way. I give $100,000 a year. And I said, well, that's fantastic. How are you making your gift? And he goes, oh, I give cash. In fact, I don't even give cash. I put it on my credit card because I have a points credit card. I get 100,000 points. That gives me 4 tickets to Florida. I can take my family to Florida every year on the United Way donation because I'm getting 100,000 points for 4 economy tickets to Florida. And I said, this makes no sense at all. You're a senior executive. You've got millions of dollars of stock options and millions of dollars of shares. Why don't you donate the $100,000 in kind via shares and save up to $25,000 of capital gains tax, depending on the cost base of those shares? And then that's worth way more than the value of those points. And then, believe it or not, he actually followed up, canceled his donation on the credit card. They reversed it and actually went ahead and donated securities. So, I mean, it's a good story. It's a true story. And it's a story I've been telling now for a decade. Because people, even very senior educated people, are not necessarily aware of the power of the donations in kind. So we'll do that example again with an individual as an executive. They have an option to buy, they have employee stock options, an option to buy 100 shares at $60 a share. That's $6,000. They're going to exercise the option when the price of those shares has gone up to $100. So they want to make a $10,000 donation. So they could sell the shares and donate the cash, or they could donate the shares acquired upon option. As long as they do so within 30 days of exercising those options, there's actually no tax. So again, if we take a look at the left part of the slide, if we were to exercise the stock options and sell the shares, we'd have a stock option deduction on our tax return, pay some tax, and ultimately get a receipt. So our cost is about $6,000. If at the end of the day, however, on the right side, we actually exercise the stock option and we donate it in kind, the shares, within 30 days to a registered charity, we pay no tax on the stock option benefit. We get our receipt equal to 50% value, and we've reduced our cost on the $10,000 gift to just below $5,000. So again, I'm not going to go over the numbers in detail, but just to show you that this is a valuable option for senior executives. And as I said in a call just a couple of weeks ago with a bunch of other charities, this is public information. You can go onto the internet and actually search for all public companies, all the option holders, how many options they have, when they expire. So if you're soliciting a major donor of a public company, like a major executive, what an opportunity to go online, do your research, and say, hey, I noticed you have some stock options that you haven't exercised, and I went online this morning and I saw the price of those shares. You're doing very well. Would you consider a donation to our charity that won't cost you anything in tax and give you a tax receipt worth 50%? So those are the kind of things we're talking about with senior executives. Let's talk now about business owners. What about a business owner? The time that we often approach a business owner, and I just had a call this morning, we're going out to meet a business owner that just sold the business for $126 million. And what an opportunity to make a massive charitable gift in the same year of sale, because that is the year you need your tax receipt. That is when you're going to have all the tax bill. So it's a couple of opportunities with business owners. Number one, if you've got a business owner or really anyone with a private corporation, if they want to donate those publicly appreciated securities from within the corporation, they have a significant benefit, because if they do so within the corporation, the entire gain, of course, is non-taxable, as I just showed you, but that value of that non-taxable gain gets credited to something called the capital dividend account, which means that you can actually pay out a capital tax-free dividend to the shareholder later on for the value of the tax-free gain on that charitable gift. So I call that the triple benefit. A business owner with appreciated securities, or really anyone with a holding company that has a portfolio of securities, if they make a donation in kind of appreciated securities to charity, number one, they get a tax receipt for the fair value. Number two, they pay no tax on the capital gain. They get a deduction, of course, for the corporate donation. And number three, they get a credit to the corporation's capital dividend account, allowing them to pay themselves a tax-free capital dividend later on, right out of the company. So it's a wonderful opportunity. As I said earlier, where we often engage with business owners is when they're selling a business. So let's say we've got a business owner that just sold the business, they've got a capital gain of $10 million, and they figure they want to make a donation, $1 million donation. So what they can do is, if they make that donation in the same year that they sold the shares of their company, what they're going to be able to do is reduce the check they're going to have to write to the CRA next April. So if on a $10 million gain at a 50% inclusion rate, at a top rate in Ontario of 53.5%, they're looking at a tax bill of $2.675 million. If they make that $1 million donation this year in 2020, which is the year that they sold their company for the $10 million capital gain, they can immediately reduce the amount of tax that they're going to owe the CRA next April by just over $500,000, the value of the receipt. In other words, next April, their tax bill would drop to only $2.17 million. So again, a great opportunity. Read the local papers. That's what I'm telling charities. No matter where you're located in Canada, read the business section every day. Because if you see the report of a business being sold, that's the year that you want to approach that donor. They've got the money. Would you consider donating a small portion of your windfall, 1%, 5%, 10%, to our charitable donation? And by the way, if you do it in the same calendar year, you're not going to have to write that check to the CRA. We often use this to promote foundations, because even if the charity doesn't, the donor doesn't know what charity they want to give it to, by parking this money in the year of sale into a foundation, either a private foundation or a public foundation, or perhaps a donor advised fund, they can then use that money for charitable giving for many years to come. What about high net worth individuals? How do we approach them? What are some of the angles? Well, a lot of the same stuff, but the thing that we add is also the opportunity to use life insurance to leave a legacy. There are two main ways of doing that. Number one, of course, you own the policy. You name the charity as the beneficiary, or perhaps you leave it to them via the will. You don't get any donation receipt every year as you continue to pay the premiums, the donor, but upon death, there'll be a donation receipt equal to the fair market value of the death benefit of that particular policy. And this can be helpful on death, right? Because you can reduce taxes if there's taxes owing on death, capital gains realization, RSP, RRIF inclusion, and things like that. The other less common way to do that is where the charity itself owns the life insurance policy. So, for example, a donor may have a policy they no longer need, where they could donate it to the charity and get a receipt for the cash surrender value. We're talking permanent policies like a UL, a universal life or a whole life policy. Or in some cases, a donor might buy a policy and then assign it over to the charity. In that case, the donor every year gets a donation receipt for the premiums that are paid annually on behalf of that policy. You don't get another receipt on death, but you get that receipt every year for the donation value, as well as any cash value if you make that donation of an existing policy. Of course, the charity needs to have a policy itself, no pun intended, on how they tend to fund these particularly donations, because there's no guarantee that the donor will continue making those annual premiums. So in some of the charities that I'm involved with, we actually get matching donors that agree to, match those premiums every year in case the donor defaults, so that we'll have a source to fully fund the policy. We look at also assessing the IRR, the internal rate of return of the policy, based on life expectancy and other things of the donor, to determine whether or not this is a good investment for the charity. The next topic I want to talk on a little bit about is foundations. And the way I always start my discussion is I say to the donor, did you know that a private foundation is public and a public foundation is actually private? And what do I mean by that? Well, if you go onto the CRA website, you can actually have a list of all the different charities. You can type in the list of any charity. So let's choose a charity that's been in the news, perhaps the We Charity Foundation. So we click on that. We can go in there and we can see all the data about the charity. We can click on it. We can see their copy of their charity information returns. We can get all the different details, compensation of their employees, the number of employees, all kinds of information. So a private foundation is public. A public foundation, to the extent that you use a donor advised fund, is actually private. So in other words, if you give to, let's say, a community foundation or various other foundation, what you're doing is essentially setting up a donor advised fund, which has the ability to give to other charities. And the nice thing is that it can be completely anonymous. In other words, you're making a donation to a big foundation, but your personal name isn't anywhere on it. Now, if you want them to, of course, tell all the different charities that you're giving who gave it, certainly they're happy to do so. But one of the nice things about these donor advised funds is that it really avoids a lot of the work, legal work, accounting work, regulatory things of actually having your own private foundation. You're basically getting a mini foundation as part of a wider public foundation. So, we're big fans of it. You get your immediate tax receipt right now. And of course, the only obligation is to distribute 3.5% of the fair market value every single year. These have become very, very popular. We have a public foundation at CIBC in our donor advised fund program, but we often work with many other charities that have donor advised funds as part of their fundraising opportunities to promote these as a great way of getting the immediate tax benefit, but then not deciding right away, perhaps, which charity the money will ultimately benefit. So it's something that we do talk about as part of our charitable planning. Now let's turn to seniors, okay? A couple of interesting points here that I don't think people are aware of. One of the things I tell seniors is, did you know that you could donate your RRSP or RRIF to charity in a very tax-effective basis? So I have a very simple example. We've got a relatively modest income senior with $45,000 a year of income, and they're thinking of making a $1,000 gift from their RRSP or RRIF. We're assuming they're already making $200 of donations during the year, so we're going to get a credit at the full higher amount. So on a $1,000 RRSP or RRIF withdrawal at a 20% tax rate for someone making $45,000 in Ontario, you're looking at about $200 of tax. The value of the receipt is 40%. Because remember, anything over $200 in Ontario gets a 40% receipt. So you get $400 back. You've only paid $200 of tax on the RRSP and RRIF withdrawal. That means that this donor would have an excess $200 credit, which can then be used to offset any other taxes that they owe. Taxes on their OAS, taxes on their CPP, taxes on their investment income. What an opportunity that I don't think the average senior realizes. If we take a look at the same example with a higher income, let's say a highest income senior who wants to take $10,000 out of their RRSP or RRIF, there is a slight cost of about 3% in Ontario, simply because Ontario has never matched the highest donation rate. So if you take a very high income individual in Ontario who's at the highest rate of 53%, and they take $10,000 out of the RRSP, they pay $5,300 of tax, but they only get a $5,000 credit because of that mismatch. In most other provinces, that's not going to be a problem. They can actually take money out of an RRSP or RRIF and donate to charity tax-free because it's an in and an out on the tax return. For anyone other than those high income brackets, you actually have a benefit because, as I showed you a second ago, you have those excess credits available. We haven't at all talked about a gift of a TFSA. So certainly you could also give TFSA money to charity. The nice thing is there's no tax when you take money out of the TFSA to give it to charity. You get a full receipt for the fair market value. So for example, if there's $10,000 in a TFSA, you take it out, you give it to charity, no income inclusion. Going to make sure that you have enough income to be able to use the donation credit because there is that 75% limitation. The question I often ask is, can it be used? In other words, if you don't have that income, how can you use the $10,000 receipt if you don't have enough income in the year? So that's an issue I want to explore a little bit further in our last section. The whole issue of lifetime giving versus giving under the will. People often say, yeah, I'll leave it to you when I die. Of course, the biggest problem is what if they don't? What if they change their mind? What if things change? What if they spend the money? So I'm a big fan of lifetime giving. Lifetime giving, of course, there is a limit of 75% of net income, 100% in the year of death in the prior year. And you've got that carry forward period, right, of 5 years in lifetime. On death, if you make a gift via the will, generally speaking, you can use that in your estate with a 5-year carry forward or in the final year of death or the year before. Let's take a look at a number of traps on estate planning. And I'll illustrate this with 3 examples. So here's the issue. Let's say on death you decide to leave your RSP or RRIF to a charity. You're going to have an income inclusion on death for the fair market value. You're going to get an offsetting donation receipt. You're going to be able to use that in the year of death with a 1-year carryback. But the question is, could there be a wasted donation credit? And what I mean by that is we've heard, and we've spoken to people in Ottawa who have heard from the CRA, that something like 2/3 of donations that are made in the will are never actually claimed on a tax return because they get a receipt, but there's no income in the final year of death or the year before. They can't use the donation receipt. I'm going to show you an example of that in a second. Number 2, is there a missed rollover opportunity? If you leave your RSP or RRIF to charity, you could have left it tax-free to a surviving spouse or partner. And number 3, if you're leaving an RSP or RRIF to charity, are you missing out on a lost opportunity to make that tax-free gift of appreciated securities that we've already talked about? So 3 examples. Number 1, this is the wasted donation credit. We've got Liam, who's single. He has the following assets on death. He has an RSP worth $50,000. He has a principal residence worth $500,000, and he has some GICs worth $100,000. He has no other income in the year of death. So how do we calculate the tax on death? Well, the $50,000 of RSP is included in his income, and he pays tax in Ontario about $8,700. The donation credit on $50,000 is worth 40%. That's $20,000, right, in a non-refundable credit. How can he use it? He didn't have enough income this year. In fact, the only income was the RSP inclusion. His tax is only $8,700. He has a receipt. $50,000 equals $20,000 of donation credit. You're going to be wasting the other $11,000. And this is a serious issue because look at the principal residence. That's going to be tax-free on death. There's no tax on principal residence. And the GICs, there's no tax on a GIC when you die. There's no disposition at fair value. It's just cash. So this is an example of a wasted donation credit. So if you can't use it for the year prior to death, then this is an example of what I mean by people are wasting donation credits by giving charity on death as opposed to during their lifetime. Number 2, are we missing out on the rollover opportunity? So we got Martin, who's married. He has, again, a $50,000 RSP, $500,000 principal residence, $100,000 GIC, no other income in the year of death. So again, he could have rolled the RSP to his spouse or partner on a tax-deferred basis. There would have been no tax owing, and it would have been better, I think, in this scenario, as opposed to wasting the donation credit to then have the spouse make that donation and use that in the future against their income. And finally, the third issue is the lost in-kind opportunity. We've got Nancy, who's single, and she has the following assets on death: an RSP of $50,000. She has some stocks with a $40,000 capital gain, and she has all this other income in the year of death, $250,000. So the issue: if we leave the $50,000 to charity, donations $50,000. What we've done is we've wasted the opportunity to gift the appreciated securities, right? Because if we donated those $40,000 capital gains securities, we'd save 25% capital gains tax, which of course is $10,000. We're still getting our donation receipt, but we could have basically saved tax by donating the securities in kind. And finally, if you leave your TFSA to charity on death, again, no income inclusion, of course, because TFSAs are tax-free. You get a donation credit for the fair market value, but again, are you wasting the credit? Are you missing a rollover opportunity to roll the TFSA to a surviving spouse or partner? Are you losing an in-kind opportunity to donate other securities that are appreciated in value that otherwise would be taxable on the date of death? And finally, I just want to conclude with just some thoughts just in terms of charitable giving. How are we going to think differently about it for 2021? Again, in my experience with the pandemic so far, and actively involved with 3 major Toronto charities, contact, right? Regular contact with donors, email campaigns, webinars, Zoom coffee meetings with senior donors, with professionals, more contact the better. We're doing this stuff almost every week, reaching out to donors, sending emails, sending videos, trying to engage all of our donors to keep them sort of involved with the cause. We've had a number of emergency fundraising appeals, especially at the beginning of COVID, when we knew that our budgets are down and donors have stopped giving. We're appealing to our top donors. Can you make up the difference to not lose our annual budget for 2020? Maybe now is the time that you start the 2021 campaign. Do we start it early rather than waiting, until next March or April or October, whenever you normally do it? Maybe now you want to sort of think about starting that campaign earlier. And then you got to be very strategic. And this is what we've done at 3 of the charities I'm involved with, where we have basically the CEO of the charity approaching the top donors first, asking them about the situation, showing them financials. If you're on wage subsidy, show them the wage subsidy. Show them if you had to lay people off. Like, show them the numbers and say, look, we need it. Then we go to the next level. We approach friends that are very, very, connected to your charitable organization. We approach board members. We have board members approach their friends and sort of do that sort of grassroots meetings, usually by video call, of course, in this current time. And then we gauge a level of their commitment for 2021. Are they going to be able, how is their business doing? How is their portfolio doing? Are they going to be able to recommit for next year? Or do we have to change our budget, change our change our operating plan? So again, it's a contact sport. I'm sure you've heard that cliche before, but it's true. It's very, very important to stay in contact with the donors. And hopefully today you've had an opportunity to watch this presentation, learn a few tricks. At the end of the day, the donor has to want to give, right? Because if the donor doesn't want to give, there's no point even having a tax discussion. But once the donor does want to give, we've given you about 5 or 6 different ideas on how to approach different types of donors to ensure that they're able to tax optimize the type of gift that they're giving. Thanks very much for allowing us to participate in your conference this year.
Well, thank you very much, everyone. We greatly appreciate you taking time out of your busy schedules to view Jamie's presentation. We hope you heard some ideas that you can take back and use at your organizations. Our CIBC team would also like to thank all of you as members of the fundraising community for your terrific work during this pandemic. We recognize that this continues to be a really, really challenging time for many of you, and yet the work that you're doing is so critical to helping us get through the pandemic. So thank you for all of the great things that you're doing. We certainly hope that you're able to get back to a more normal state of operations as quickly as possible. So in closing, CIBC considers it a great privilege to be able to support the charitable and not-for-profit sector, and we hope you enjoy the rest of the conference. Thank you very much.